Thanks for joining today's call. I, Amit Manjrekar from Aditya Birla Sun Life Asset Management welcomes you all. Hope you and your loved ones are doing well in the current situation. Festival wishes to everyone. It's like happy Pongal, happy Makar Sankranti, happy Bhogi and happy Lohri. Today is the fourth session of Niveshko Samvaad. And in today's session, we are going to discuss about the outlook of the market. For all the new joinees, every third Saturday of the month, 11 to 12, we conduct this session, and this is purely based on the value addition. Today, we have three guests to guide us for the next year's or the current year's investment journey. So it's my honor to introduce first our guest, who is Mr. Mahesh Patil, who is a CIO of Aditya Birla Sun Life AMC Limited. As the CIO, Mahesh oversees over INR 2.7 lakh crores of assets under management. With close to 30 years of rich experience in fund and investment management, Mahesh leads the entire investment team comprising fund manager and the analyst. Mahesh has been with Aditya Birla Sun Life AMC since 2005, where he started as a fund manager. In 2008, Mahesh became the head equity and subsequently chief investment officer in 2011. He was given the charge of spearheading the overall investment function as the CIO in 2021. He personally manages funds as ABSL Frontline Equity, ABSL Focused Equity, and ABSL Multicap Fund. An engineer from the VGTI Mumbai, Mahesh is an MBA in Finance from Jamnalal Bajaj Institute, Mumbai. He is also a charter holder from the Institute of Chartered Financial Analysts, ICFI Hyderabad. So Mahesh, welcome on the board. Our next guest is Mr. Bhavdeep Bhatt, who is head of retail sales. He is head of retail sales at Aditya Birla Sun Life AMC Limited. He has been a part of the organization since March 2008 and brings with 25 years of the experience. Bhavdeep has previously worked with Gujarat State Machine Tools Corporation Limited, TVH Brokerage House Private Limited, Kiran Motors Limited, Kotak Mahindra Asset Management Company Limited, and ICICI Prudential AMC Limited. So he holds a bachelor degree in commerce and master's degree in business administration from Bhavnagar University. In a career span of 25 years, Bhavdeep has led several first kind of its kind innovative products across asset classes that have led to a number of accolades. He has been pivotal in the launch of 33 products within equity, structure, and alternate product space, aggregating mobilization of over rupees 20,000 crores across 1.5 million retail and high net worth individual investors. At Aditya Birla Sun Life AMC Limited, Bhavdeep has conceptualized and executed the launch of number of products, customers, and business solutions like Century SIP, fixed income propositions on alternate platform, Samper, Privilege Club, a loyalty program for the IFAs, and most recently strategic sales group. Bhavdeep has previously worked with ICICI Prudential AMC Limited as head new product development and communications, and with Kotak Mahindra Mutual Fund as a vice president marketing, products, and communication. Prior to 2001, he managed sales and marketing functions for Kiran Motors Limited in Surat. So Bhavdeep, once again, welcome to this session. And the third, our guest is Mr. Vinod Bhatt. So Mr. Vinod Bhatt, he is a portfolio manager and equity strategist at Aditya Birla Sun Life AMC Limited. Vinod comes with an overall experience of 2 decades with close to 15 years in the financial markets and investment banking space. He has been associated with Aditya Birla Sun Life AMC since July 2018. Prior to joining Aditya Birla Sun Life AMC, he was a vice president, corporate strategy and business development with Aditya Birla Sun Life Management Corporation Private Limited. Previously, he was an investment banker at Credit Suisse and Ocean Park Advisors in the USA. Vinod is a CFA and has done his MBA in finance from the Wharton School, University of Pennsylvania. He holds an MS in industrial engineering from Pennsylvania State University, USA, and BTech in mechanical engineer from IIT Bombay. So welcome all. And my first question to Mr. Mahesh is, Mahesh, I mean, everyone says that, has Indian market peaked out or it's really different at this time? So what's your view on this?
Thank you, Amit, for the introduction, and welcome everyone to this Saki Se Samvaad. Wish you all a happy new year. So I think that as we step into this calendar year 2022, and even earlier also, I think the key question was everybody's mind was, have the markets peaked out? Because the one number which everybody was looking at is the valuation multiples, right? The PE multiples. And the market P multiples on a, say, trailing basis or a 1 year forward basis was looking very high, almost equal to what it was there into the earlier peaks, right? We had three peaks in the last 20 years. One was in 2000, right? Then other one was in 2008 before the global financial crisis. And then sometime in 2013. And the P multiples were actually in that region, right? Somewhere around, say, 24, 25 P multiple and on a forward basis around 22 P multiple. So obviously the question was that, and the markets are also rallied big time, right? From the bottom, more than doubled. So when we try to really look at it and see that there is a couple of differences, 2 or 3 big differences which are there, right? Which makes us believe that we are still not at the peak, though the valuations are looking expensive. So one reason is that in the previous cycles, okay, when the markets peaked out and then there was a major crash or a down cycle or a bearish phase in the market, a period where we had strong economic growth in the prior years. I mean, if you look at the classic case in 2008 when the markets peaked out, prior to that, for almost 4 years or 5 years, we had very strong growth. In fact, the GDP growth rate in the 3 years prior to the market crash was around 9.5%, India's GDP growth. This time around, we are coming out from a pretty low kind of growth, economic growth, primarily impacted also by the COVID crisis. And even pre-COVID also, our growth trajectory, India's was tracking below is long-term potential trajectory, which is around, say, 6.5% or so. Because of the various factors, okay, which had impacted growth earlier, GST implementation, the banking and financial services crisis, the big, large corporate NPAs, which were there. And so we are actually coming out from a phase of weak economic growth and actually going ahead, looking to slowly accelerate that growth and getting into a pretty strong growth in the next 2 or 3 years. And we'll talk about that. So the big difference is that we are actually coming from a weak economic cycle and accelerated kind of a earnings growth in the next few years before we reach our potential growth rate of around 6.5–7%. So that's the big difference. And as you know, so there is enough runway for the corporate profits to reflate from here and continue to grow stronger than what we have seen in the past. So this is also reflected in this chart, if you look at over here, which shows that the corporate profit to GDP, which is an indication of the health of the corporate India, right? So that kind of bottomed out in FY20, and it has been kind of coming down from 2013-14, okay, when we saw the markets kind of peak out, when the economic activity kind of peaked out. And in the earlier peak, for example, we have seen corporate profit to GDP was as high as around in FY08, 7.8, and it had gone to as low as around 2%. And now it's starting to improve. In FY21, it's 2.3. In FY22, again, we are seeing a strong corporate earnings growth this year. By FY22, we will probably close at around 34 or 35% earnings growth. So we are coming out from a very low, depressed earnings phase, right? And that's the reason why the market P multiples are looking expensive. So when the earnings are depressed, one is the price, but the denominator is the earnings, which is depressed. So that earnings will reflate back, right? There will be a mean reversion of the earnings, again, driven by multiple factors. We're seeing that a lot of industries are now participating in this growth. I mean, earlier it was only in FY18, 19, 20, it was only a few sectors like IT, for example, or the consumer sector, which was doing well. And most of the sectors were kind of struggling. But now we are seeing that not only the stable, steady sectors like consumer, IT, and pharma, which is doing well, but also the cyclical sectors are also likely to do well on the back of the economic recovery. So whether it is the auto sector going forward, the cement sector, the capital goods sector, infra sector, consumer discretionary, metals again has been doing very well. So it is the earnings growth is going to be much more broad-based, and that is going to ensure that the corporate profit growth in the next, say, 3 years or so will be in the mid-teens or so. I mean, if we go back in the earlier slide, just to highlight that if you look at the corporate earnings growth in the last 4 5 years, I mean, until 2020 was around just about 5% or so, right? It was tracking well below the long-term average growth rate of around 11 12%, what we have seen in the past. And this time around, even despite COVID, right, you would have seen that COVID crisis hit us in FY21, somewhere in mid of FY21. Despite that, actually, profits in that particular year grew by around 13%, which was actually much higher than what we had seen in the last 5 years from FY15 till FY20. And one would wonder what really led to that, right? When the GDP actually contracted. So many large companies and corporates were able to really cut down their costs. A lot of costs, also discretionary costs, came down because people were working from home. But companies use this period to bring down and work on the efficiencies, improve their productivity. And while top line growth was kind of slow, but we saw a margin improvement over there. Also, in this period, many companies have actually been able to delever quite a bit. So overall, if you look at debt to equity ratio, which peaked out probably in FY17 or 18, 17, I would say, has been coming down, and corporate India has been deleveraging. And all the cash flows which were generated in the last 2 years, specifically FY21, have been used to bring down the debt. And that has also helped in terms of reducing the overall interest cost. So we have seen that in a weak economic environment, also corporate India was able to actually do reasonably well in earnings growth. And we've seen that momentum actually accelerate in FY22. In fact, in FY22 also, as you would recollect, that we had the second wave of COVID, which hit us, and it was pretty bad. Despite that, we haven't seen much downgrade to earnings for FY22. In fact, earnings growth in this period is likely to be around 35% or so. And again, driven by probably a few sectors only, like large, like metals or banking and financials, okay, which have seen a big turnaround. I think going forward, in an environment now when GDP growth, which is likely this year will probably grow at around 9% or so, next year also around close to 9%. And then around 6.5%, 7% or so is what I think our trajectory would be. And as you saw earlier, there's enough room for corporate profit to GDP ratio to again reflate back to the earlier levels. So I think we are in a cycle where earnings growth at least should be fairly strong, which is compared to a weak growth cycle in the earlier years. So that's again a big difference, okay, and why we believe that the markets are not kind of peaked out over here. Secondly, if you look at inflation, also inflation in the earlier periods when the economy kind of heats up, go back to the earlier slide, okay, in the table which we have seen, inflation normally heats up when economic activity is very strong. And we saw that in the earlier period when the market inflation was high, around 6-7%. Currently, inflation is slightly inching up and is a cause of worry, but we believe that it is more transitory. It is more driven not by the supply side, demand side, but it is more driven by the supply side issues, the bottlenecks which have been created because of this pandemic, and certain issues like, for example, chip shortages and this thing which are plaguing the industry. So these things will get eased off in the next 6 months or so, and we expect inflation to probably moderate down. And if you look at interest rates also, what happened in the earlier market before the market peaks out, the interest rates kind of started to rise slowly, and they went to as high as bond yields went to as around 8%, 8.5% or so. Currently, we are still at the bottom of the interest rate cycle. Globally, also, we have just about started now to increase interest rates, right? And there's a long way before we see that interest rates actually go back, okay, to the earlier levels, okay, what we've seen. So that again is a big difference, that interest rates are still low. Bond yields currently, while they have gone up to around 6.4% or so, we don't see that going say beyond 7% even in the next 1 year or so. So that is another big difference. I think it will take a long time before you see bond yields going to around 7, 8% or so. Okay, that's only when the economic activity really heats up. So that's again still far away. So all these things makes us believe that the market is still in its kind of a bull market, or kind of a market which will continue to scale new highs, and driven by pretty strong economic growth as well as corporate earnings growth. And however, I think what is a big change this calendar year compared to the last calendar year is that we have seen last year was a kind of a total risk on rally, right? Everything went up. There was huge amount of liquidity which was pumped in by the global central banks. The central bank balance sheets in US and this thing increased by almost like $4 trillion. And interest rates were almost pegged at zero globally. So that led to a risk on rally, and it was a kind of a one-way market, right? Without any kind of a correction, despite major risks, okay, because of the lockdowns and this which we saw, except probably in this latter part of the last calendar year where we saw some correction, around 10% correction in our markets. But this year, that is going to change. You would probably see the whole liquidity is slowly going to come down, right? Fed has already announced tapering, but I think while they will complete their tapering, okay, by the mid of this calendar year, but still overall liquidity will still really be fairly decent. And they have also indicated that they will start increasing interest rates. I mean, we're expecting around 3 to 4. I think around 3 rate hikes is what you could expect in this calendar year. So that is a transition phase, okay, which we are seeing some normalization of the whole policy environment, which is going to happen in this calendar year, which is likely to lead to some amount of volatility, right? So you will see that now risks will probably get priced much better, which was not the case last year. So one has to be a bit careful over here in this calendar year. One has to look at the risk reward more closely in stocks and in the sectors, and then really invest over there, because the markets will probably be more discerning this year. So companies which disappoint, for example, in earnings, or there are serious downgrades, I think those stocks will correct, which was not the case around 6 months back, right? We saw that even companies which didn't really report strong numbers, the markets were very forgiving, and companies still continue to scale higher. I think that would probably change in this calendar. That's the major change which I see. And since the market, we are in this kind of a transition phase where economic policy is now getting normalized, you will see that valuation multiples, okay, which had kind of stretched and were at, say, 2 standard deviation above the long-term average, or 1 standard deviation above, I think that will probably normalize a bit. So while you will see strong earnings growth in this fiscal year and also in the next fiscal year, there will be some moderation of P multiples. And as a result, the market returns will probably be more moderate in this calendar year. Okay, I mean, very difficult to hazard what kind of a number, but it will be slightly lower than the earnings growth is what one can assume in this calendar year. But I think there is no doubt, I think in my mind, that the markets will continue to scale higher. We are somewhere in the kind of, I would say, the mid of the whole economic cycle, or the beginning of the economic cycle, and probably at the mid phase of the whole market cycle, because market has run slightly ahead of fundamentals. There's no doubt about that. We've seen that because of the liquidity and which came into the market. But we are still somewhere in the mid of the market cycle, and still there is a long way to go, okay, for markets to peak out. So outlook remains, I think, over the next 2-3 years, we think markets can still give reasonably good returns, okay, on a risk-adjusted basis. And as a result of that, one still should continue to maintain a positive bias on equities and continue with one's allocation. So yeah, that's I think how we see the markets. I mean, this calendar year, even from a slightly longer term perspective.
Sure. Thanks, Mahesh, for I think giving us a very crisp answer. The next question is to you only. I mean, it's a prominent belief that India at the cusp of the new growth cycle. So, what's your view on this?
So I think that's what we've been highlighted over here. When you say India is the beginning of a new growth cycle, we're talking about the whole economic cycle. And as I said earlier, India's GDP growth, while it came down sharply and across the world, we saw a sharp decline in FY21. But even prior to that, okay, the pre-COVID, okay, our GDP growth was kind of trending much lower than our potential long-term growth rate, which is we think is around 6.5%. If you look at long-term potential growth for India, is around 6.5%. We have grown at times at much higher than that and times lower than that. So that is what we were coming in. And I think while COVID did hit us and the GDP contracted, but I think coming out of that, we are now seeing that India is now poised to actually benefit. I mean, as I said, that every crisis is also an opportunity, right? And this crisis, we have seen the government also kind of coming together. In the budget, we saw it was a pro-growth kind of a budget. The government also realized that they need to really push the economy and bounce back. So we saw a lot of focus from the government. I mean, continuing from the earlier reforms which were done. And mind you, the growth trajectory in the earlier period, say from 2016, 17 to 20 was slightly lower also because of the reforms what we did, right? The big ticket reforms like the GST implementation, what we saw, the banking and financial sector reforms, okay, which kicked in, the real estate sector reform, right? The RERA and all these things. Those things had some short-term impact, right, in terms of growth. But what it has done is that all these things, whether it is the whole bankruptcy code, and have strengthened like for example, the banks much better. The resolutions of the NPAs is now happening much faster, and the bank balance sheets are now in a much better shape. So even for that matter for real estate, right? So all these reforms are now set a foundation for a much stronger and a sustainable growth in our economy going forward. And also the government's push, okay, in a few sectors to revive the whole capex cycle and investment cycle. Right? The Modi government, they talked about manufacturing, okay, early in 2013-14 when they came to power, but nothing really happened. But I think now is a time when a lot of things are now falling in place. And we think that the whole investment cycle in India or the manufacturing in India, which was a kind of a initial dream, is now likely to fructify. A lot of enablers are in place, like tax have been cut, right? We have been corporate tax for new capex is now down to around 15%. Government has the whole logistics side has seen a big improvement. I mean, infrastructure was a big bottleneck. Like India, the biggest challenge for high cost of production was not only interest rates, but also the logistics costs. And we've seen that the road infrastructure and this thing has improved. The port infrastructure has also improved. The dedicated freight corridor is just about getting started now. And I think on the logistics side, we've seen a lot of things have really happened, which is again a big enabler in terms of reducing the whole logistics cost. And the government push on PLI, the whole production link incentive schemes which the government came, which is across sectors, right? Which is consumer electronics, auto ancillaries, textiles, pharmaceutical, API, all these sectors, consumer durables, the scheme which has been rolled out. I think that is now slowly starting to get traction, and not only domestic Indian promoters, but also some of the global majors are now setting up plants. We've seen that big investments happening in the mobile phone sector, right? And India now actually is manufacturing almost like 90% of the mobiles are now, 95% of mobiles are now manufactured in India. Though the value addition is still lower, okay? But the fact is that earlier we were importing most of the mobile phones. And I think that is, again, likely to see a pickup in the whole investment cycle. So if you look at the overall GDP, there are three components to it, right? One is the consumption, right, which is still a large portion of the GDP, more than 50% of that. Then there is investments, and there is net exports, right, which are the three components of GDP. So the investments cycle, I think, is likely to slowly pick up. It's still early days because the growth is still catching up and capacity utilization levels are still slightly lower. But I think soon you will see the capacity utilization level in a year down the line with demand picking up should move up. And with the whole push, what we see, we think that investments which were kind of dragging GDP down in the last 5 years, if you look at the investment to GDP ratio has been steadily coming down. We think that has now bottomed out and is likely to increase. Again, driven by, as I said, first, the government push, to manufacturing, to the production link incentive scheme. That's one. Third, secondly, is that the corporate balance sheets are now in much better shape, right, to further leverage and to further kickstart and make fresh capex. As I said, the whole debt to equity ratio has come down, for corporate India in the last 4 years. So that is, they are in good shape. The banking sector is also in pretty good shape now, right? I mean, after the COVID crisis, there were a lot of fears that you would see a large NPAs, but I think the banking sector has managed that well. The NPAs are now likely to come down. Corporate bank balance sheets are also fairly well capitalized. So they are willing to now fund the new capex cycle and geared to do that, right? And I think the real estate is another sector which is a large part of the overall gross fixed capital formation. That is also on a revival path. Again, here also we have seen last 5 years or last 6 years, this sector has been going down. And because of factors like triple factors of lower interest rates, affordability gap, has come down because property prices have remained now plateaued for the last 4-5 years, and income levels have gone up. And the sector has also gone through a lot of consolidation now with more organized player coming into the sector. There's a lot of consolidation which has happened, which has given confidence to new buyers coming in and also confidence to lenders. So the sector is now getting funding at a much more attractive rate, especially for the large developers. And they have been able to also monetize some of their assets. So I think all these factors are enablers for the real estate sector to start to come into a new cycle. And normally these cycles last for around 3 to 5 years, right? So that will also be a leg which will drive support investments going forward. And there are a lot of sectors which are dependent on the real estate sector, be it cement, steel, and the consumer and home improvement sector. So, and also employment, right, in this sector is very large. So I think that's, we've seen this sector revive, and recently we've seen the inventory in the system in the real estate has also come down quite a bit. So that's one leg which will drive. Consumption is still weak because of the COVID. We are still coming out of that second phase, and this third phase is also hitting us. But I think India consumption has been fairly steady. Rural consumption has got impacted a bit, but I think that should come back, I think, in the next cycle. But within consumption, I think the whole discretionary consumption is likely to really come up in a big way. I think India is at a cusp, at an inflection point where the per capita GDP is crossing around $2,000. And at that point, we saw in China also, there is a demand for a lot of consumer discretionary items starts to go up. And I think that is what we're seeing in India. I think the share of consumer discretionary as a part of the total consumption basket, which is around 25%, will probably go to around 35% in the next 10 years. So I think consumption slowly and steadily, again, the demographics, the new generation, I think will continue to drive that, though it is still going to be slightly slower, I like caution, than what it was in the past. But clearly it will revive from here. And then finally, exports. I think for the first time we're seeing exports, India has been able to do pretty well in the last 1 year. Exports have been going very strong. Again, partly driven by the strong recovery in the US markets. India has a large share of export to the US. US GDP growth has been very strong. But I think exports are driven on two fronts. On the services side, I think IT has been doing phenomenally well. I think IT sector is seeing a very strong demand growth environment. We've seen that commentary from the large IT names, and exports of even goods, and this thing has also gone up. And India is benefiting out of two things. One is the China plus one policy globally. After the pandemic, we've seen that a lot of supply chain globally is now trying, which was dependent on China, is trying to diversify. And India is well placed in a few sectors, like, for example, chemicals, pharmaceuticals, or auto components, okay, textiles, to take advantage of that. So we've seen India's share of the global trade has gone up a bit, and I think going forward that trend will continue. And I think the government thrust also to all these PLI schemes which have been introduced are not only to cater to the domestic market investments over there, but also to cater to the global market. So that is also benefiting overall exports. So I think so all these three pillars of this thing are going to fire, though probably consumption will still be slightly weaker, investments will also pick up. But I think clearly over the next, we're seeing the GDP growth going to around 6.5%, which is going to be might not be as great as one would have thought, right? We've probably seen around 8-9% GDP growth in the past. But in the global context where we are, right, even when China is also kind of slowing down, China, which used to grow at around 9% or so, 9-10% is likely to grow at around 4.5% going forward. I think India's GDP growth would be fairly strong on a global relatively, even amongst the other emerging markets. And that's why we think that the outlook, because of all these factors, the economic standpoint, I think we are fairly positive on that. Also, I think one more thing which I would like to highlight over here is that India is now emerging as a startup. This whole startup ecosystem in India is now coming to age, and still early days. But because I think we've seen the adoption of digital in India, the adoption of the mobile digital penetration, and the whole Jan Dhan and whatever on the Aadhaar link is actually help India to really leapfrog during this COVID crisis. And we've seen the adoption of digital has been phenomenal and pretty fast. And the new generation, the young generation, the Gen Z generation has been able to really get onto the digital world much faster. And the whole startup ecosystem in India has flourished very well. Again, a lot of funding has come into this space. We've seen India has seen the largest number of unicorns in the last 1 year, almost like 30 to 40 unicorns. Unicorns means companies with more than $1 billion kind of a valuation in the private space. And that has also, because of the India, I think the whole opportunity size, which is a large market, we've seen a lot of private equity money has come into that space. Big money has come into the space in the last 1 or 2 years. And that has also been reflected in the large FDI flows, what we saw, around $75 billion of FDI flows in the last calendar year. But what this does is that the whole startup ecosystem, that whole money which is coming in, it's creating a kind of entrepreneurial culture in India. Anybody has a good idea can now get funding and can start up a venture and really get it to the market. It's also creating a lot of jobs, right? A lot of these players, like with Zomato, Swiggy, and the players, they are creating new jobs, and the whole money which is coming into the ecosystem is getting spent, right, in various ways. So that is also, I think, if this bootstrap and what we saw in some of the other markets like China is now gone to the other side. Okay, we're seeing government clamping down on something, but they also had that phase. We've seen in US has been a big success story. I think India is also probably coming of age over there. And a lot of these companies are now also getting into the public markets. India has got the whole capability on the digital side, on the technology side. I think India is well placed, okay, to give a boost, okay, to this whole startup, the whole digital revolution, what we are seeing. And I think that will have its own kind of impetus to the whole economic revival is what I think. So all these things, I think, yeah, clearly we are at the cusp of a new cycle. And while it will be slow and gradual, you will not see that because there are some headwinds over there, but clearly we are on a path towards that.
Thanks, Mahesh. My next question is to Vinod. Vinod, what's your view about the flows to the emerging markets?
So on the global front, we are seeing that global equity markets are climbing a wall of worries on a number of fronts. To start off with, we are seeing that growth is peaking out, whether it's in the US, Europe, or China, for example. So in the US, growth is still expected to be strong, driven by the strong household balance sheets and the corporate balance sheets and the government spending on infrastructure. But it will still be lower than what we saw last year. And the concern on the US front is more on the inflation and rate hikes, as you all would be reading and hearing. Right? So inflation is at a 40-year high. The last print was at 7%. So what is expected now is that the Fed will end its tapering in March, and we'll see the first rate hike in March, and about 3 or maybe even potentially 4 rate hikes this year. And the Fed may also start contracting its balance sheet this year itself, right? So whenever that happens, we are seeing that the US 10-year has spiked to about 1.7%. The dollar has also strengthened to about 95, 96 levels. So historically, what we have seen is that in this kind of environment, the emerging markets typically come under pressure when US rates are rising and the dollar is strengthening. Also, as the US growth slows down, and we are seeing a shift in demand from goods to services. So last year, the goods demand in the US was pulled forward. And this year, we are seeing there's a shift from goods to services. And typically, emerging markets are exporters of goods to the US, right? So if the goods exports comes down, then the emerging markets growth will also be impacted. And thirdly, China is slowing down. We are seeing that because of their common prosperity agenda, the government has been putting some regulations in place. So whether it's, for example, for the real estate sector, internet sector, edtech sector, and so on, they have come out with more stringent policies. Also on the ESG front, in terms of environmental concerns, climate change, the government is taking stricter action. They are shutting down some of the capacities in the metals and commodity sectors and so on. So all this that is impacting China's growth, and we are only expecting real GDP growth of about 4.5% for China over the next few years. And the Asian emerging markets are largely dependent on China's economy. So if China's economy slows down, the Asian emerging markets also see slower growth. So because of all these reasons, we are seeing that maybe this year and for the next couple of years, the emerging market economies may not do as well as they were doing earlier. However, in this environment, India kind of stands out. As Mahesh just walked us through, we are expecting that India's economic growth will go back to its trend of 6.5 to 7% real GDP growth over the next 3 years, driven by investments, exports, and by consumption. And even the macro backdrop is very favorable for India. So, inflation is is under control at about 5.5%. Our interest rates also under control at about 6.5%. We are seeing that fiscal deficit is being managed well. So the government is in no hurry to consolidate the deficit, and they will support growth. And we'll see policies even in the budget. We are expecting policies to support growth. The current account deficit is also under control. We are seeing that the FDI flows have been quite strong at about $70 to $80 billion on a gross basis every year for the past 2-3 years, and hence our forex reserves also at an all-time high of about $640 billion. So the import cover is high. External debt to GDP is also manageable, and hence from an overall macro perspective, from a growth perspective, India seems to be in a much better position compared to the other emerging markets. And hence, it will continue to be an attractive destination for the FIIs. So we are seeing that in the FII flow data also. So if you see this table, in the past 3 years, calendar year 2019, 2021, India has got positive FII flows, whereas many of the Asian emerging markets have seen negative FII flows, right? And like I said, this year, we're expecting policy tightening in the US. We're expecting, rates going up and dollar strengthening, and that can impact the FII flows to emerging markets. But given that India may be a standout amongst Asian emerging markets, so we're expecting that FII flows to India should continue even this year. So while the FII flows to other emerging markets may slow down and we may even see outflows. We are expecting this trend of positive FII flows to India to continue even in calendar year 2022.
Okay, that's interesting. Everyone asks, and it's very, interesting thing that, which are those key sectors or, interesting things you feel for this current year?
Yeah, so I think we've talked about some of the key trends earlier. Also, we had a conversation on that. I think more or less remain the same. So first is, I think, obviously to play the economic recovery, right? The best play is the banking and financial services sector, right? Because that's a play on the economy. We've seen that in the last 1 or 2 years, overall credit growth has been fairly weak, right, in mid-single digits or so. I think that is slowly likely to, as GDP growth comes back, normalizes, you would see credit growth coming back to double-digit growth next year. But more importantly, I think the banking sector has gone through a major crisis on the corporate NPA side. We saw large corporate NPAs around 2 years back. There was a cleanup which happened over there. So the bank balance sheets are fairly clean. And post-COVID, also the bank's balance sheets were very stress tested in a way, right? Especially the retail balance sheet, right? Because retail hadn't seen any major crisis. And during this period, there was a big concern that you will see large retail NPAs and that could hit the banks, especially the retail banks. While there was an impact, but it was something which was manageable, right? And we've seen a decent recovery after that. Even this third wave of Omicron probably is not going to impact much because we're not seeing any major lockdowns, while the virus will probably spread much larger and infect more people. But we don't see any kind of economic impact or job losses because of that. So the banking sector will do well because credit growth will pick up. Secondly, you will see the NPAs, the whole credit cost, which was impacting profitability, right, is likely to go down because corporate NPAs are virtually now very, very low. And retail NPAs also, I think, as things recover, will moderate down. So that will drive pretty strong profit growth in the next few years. In fact, this year also banks are showing, especially the large private banks are showing good growth, and that will continue. And overall banks' balance sheets, they are well capitalized. I think that is another important factors. And overall valuation in the banking sector is also fairly reasonable. Most of the large banks, if you look at it compared to the historical, the market's PE multiple is above the long-term average. The banking sector in aggregate will be somewhere near the long-term average. So they're not really expensive. They've underperformed also in the last 1.5 years, the whole banking and financial services sector. So I think it's time that start to perform on the better earnings outlook. Here again, within that, there'll be some differentiation. I think banks which are more, the private banks specifically, and banks which have got more adapting toward digital in a big way, I think we'll be able to differentiate and be able to do a better customer acquisition at a lower cost and keep their costs under control. So I think that is what one wants to look at. And the whole fintech space is also kind of coming up. Okay, it can be disruptive also. So it will be only the large private banks which are probably working towards digital also in a big way. I think will do well in this space. Then the whole real estate cycle, which we talked about, I think there are structural tailwinds to that, which we think which are there in terms of low interest rates, the whole affordability gap which has come down, more RERA which is coming in, which gives a lot of protection to the buyers. So there is a genuine demand, okay, which is there. In India, there is a large potential demand which is there. And with these factors in place, we've seen that demand now slowly starting to materialize. Confidence is coming back. Also, developers are now probably targeting ticket sizes in line with the market segments, right? So I think real estate and the sectors linked to real estate, which is say building materials, home improvement, cement, I think should do also well as the volume in the real estate sector start to pick up. So that's another theme which we like. And then consumer discretionary has been kind of a long-term secular theme for us, especially the low-ticket consumer discretionary items. And this has got impacted during this COVID crisis. So the discretionary demand has definitely got impacted, but this is a more secular theme, which as I said earlier, is being driven by the per capita income going up, the share of discretionary consumption, the spending on discretionary consumption as a share of the total consumption pie is likely to go up in India. The move from unorganized to organized, that is going to benefit this sector. So, so this space, which includes like companies like sectors like consumer durables, okay, home improvement, and all these sectors are likely. This is a kind of a more longer term thing for us, which we are positive on. Then the whole rise of domestic manufacturing, which we are seeing after a long time, driven by these PLI schemes and and the government support. So that is likely to pan out, and that will benefit the industrials and the capital goods sector, which we would be positive on this space, because as investments happen over there in manufacturing, you'll see order book for some of these industrials and capital goods companies starting to improve going forward. So that's another thing which we're looking at. And then finally is the whole digital transformation, which is happening globally. In India also, it's happening at a much rapid pace. Globally, we've seen a lot of the majors companies are still really lagging behind in terms of the whole digital transformation. They need to modernize their core infrastructure. The move towards the cloud is also happening at a rapid pace. Increased adoption of AI. So all these things are driving spend toward the digital side, and Indian IT companies are now well geared to target that opportunity, and they are likely to benefit. But more importantly, I think there are a lot of companies which are not the digital IT service provider, but also digital enablers which are there, and the whole technology space. Okay, the new age technology companies are now coming of age in India, right? And that can be an opportunity, I think, going forward. And you'll see more of these companies getting listed into the public markets as we move forward. So these are some of the themes, okay, which we like. Again, this is a chart which shows that which are the major unicorns in the last calendar year. We have seen major companies actually seeing funding, getting large amount of funding, and getting into the bracket of what we call unicorns, right? More than $1 billion of valuation. There are significant names which are there. Some of these companies will come to the public markets, okay, as they mature, as their business models, okay, mature, and they see a roadmap towards profitability. You will see them coming into the public markets, and that could be an opportunity. Okay, there will be successes, there will be some volatility, there will be companies which will probably not do well, but some of them will create immense value, and that's an opportunity which one should be looking at.
Thanks, Mahesh. And before taking the second last question, okay, let me request all the viewers, please post all your questions in the Q&A session. So we know the next question is, of course, we discuss all the positive things, but what could be the key risk for Indian equity markets?
So we look at risk both from a global as well as from a domestic point of view. And as you can expect on the global front, right now, the biggest risk is the inflation and rate hike scenario in the US. So currently, what is already priced into the market is that inflation will be high till about March, after which it should start declining in the US. The tapering should end in March, and with the first rate hike happening in that same month, and about 3 rate hikes this year and another 3 next year. And the Fed to start contracting its balance sheet maybe in June, July, right? So that is what is already priced in. So the risk here is, for example, if the inflation is higher for a longer period of time in the US, which leads to an even more accelerated rate hikes from the Fed, right? So that is what we are monitoring. The second major risk is a greater than expected slowdown in China. So given their policy changes, focus on the environment, so we are already projecting just about a 4.5% real GDP growth rate for China over this year and for the next couple of years. But if, for example, the government goes even more stringent on the policy front, then we can see further downgrades. However, at this time, given there is a election expected in China at the end of this year, so the government is now trying to balance growth with its policy changes, and they are going slow on further policy changes. The third, of course, is the oil prices. We're already seeing Brent crude prices have gone up to almost $85 a barrel. And that is an important macro variable, which I'll just come to in a minute. On the domestic front, of course, COVID remains a risk, but not as big of a risk as it was over the past 2 years. We are seeing that the Omicron variant is spreading quickly, but it is much more mild than the previous two variants. And hence, we are not seeing the kind of lockdowns that we saw earlier globally as well as in India. And hence, we don't expect the impact on the economic growth to be as bad. And of course, there are state elections happening this year, especially in UP. So in case of any adverse results there, that might stall some of the policy initiatives of the government, although that is not expected. So the two tangible risks, of course, remain the rate hikes and the oil prices. So in India, we are expecting the RBI to hike rates 2 times this year. So it will still be manageable. And even from a rate hike point of view, the Fed has been communicating their intentions well in advance. So that is all priced into the market. And as we discussed, India's macro position is very healthy right now, whether it's inflation, fiscal deficit, current account deficit, and so on. So even if there are gradual rate hikes in the US, although the other emerging markets may get more impacted, India should still be able to manage the situation quite well. And the other risk, of course, is the oil prices. Currently, we're expecting the Brent crude prices to stay in the $80 a barrel range this year. So ideally, if crude prices are in the $65 a barrel range, that is best for India. But $80 is still manageable. And even if it goes up to $100 a barrel for a month or two, India can still manage that. So on both these tangible risks, we think that these are quite manageable as far as India is concerned. So overall, from a risk point of view, we are monitoring mainly the rate hike scenario in the US and the Brent crude prices. And as of now, as long as the rate hikes are gradual and crude prices remain around $80-85 a barrel, these should still be supportive of equity markets.
Thanks, Vinod. And this is the last question to you and Mahesh as well. As an AMC, we have so many schemes, but considering all the discussions we had, which should be the top schemes investors should keep on their watch list for the asset allocation?
So let me just see. Overall, I think what we're seeing is that on the asset allocation side, on the equity side, and we also run the asset allocation fund. I think going forward, if you look at next 1 year or so, I think the risk reward is equally spread across, say, large caps, mid caps, and small caps, right? Probably in the current environment where we're likely to see slightly more volatility in this calendar year, and there could be some periods of market correction. I think large caps also offer a good, reasonable comfort over there. And that's why we're seeing that large cap allocation should be around, say, 25-30% or so. Within that large cap space, okay, so I'll just take you through this thing. So large cap around 20-30%. Larger allocation should continue to still be towards the flexi cap, diversified flexi cap category, because as I said, best way to play large, mid, and small cap is through this segment, and the risk reward is equally spread out across all these three categories, and the fund manager can really do their allocation best where he thinks. Again, mid and small cap will continue to continue to make allocation over there, while mid and small caps have had a very good run in the last 1.5 years. They have done very well. Valuations are no longer as attractive as what they were around a couple of years back. But I think as the domestic economy recovers, I think the mid cap and small cap will continue to show a better growth over there. Obviously, it has to be slightly much more nuanced now in the mid cap small cap space, because the big runaway rally, what we saw, I think will probably moderate down a bit, and markets, as I said, will be much more discerning. So it's very important to really choose the mid and small caps based on fundamentals where we see earnings growth visibility, but one can continue to make around 15-20% allocation, and then around 15-20 to thematics, okay, funds. So we can briefly talk about each of these funds. So on the large cap, I would suggest the Frontline Equity Fund, which is our flagship fund, and the largest fund over here. This fund at this point in time, okay, as you know, this is a pretty well diversified fund. Okay, it maintains exposure across sectors. Okay, with a deviation of around 30% related to the benchmark. And in the current environment where we're seeing the market breadth is likely to be much better, we are seeing many sectors now participating. I think this fund will be a good fund in the large cap space to be able to participate across sectors and take the best stocks, okay, within those sectors, right, which can generate alpha. Again, here we take around 20% exposure to mid caps. Currently, we are at around 10-11%. Yeah, potentially we could look at another, say, 3-4% to add in the good quality mid caps, which can give us ability to generate better returns. We have done that in the past successfully to generate alpha. Again, this fund is slightly very well balanced between growth and value, I would say. Right, we have got some good growth stocks. Okay, and there are some value stocks also which are there in the portfolio, like in the utility space and oil and gas sector, but in a very measured manner. And this year you would see probably value also starting to do a bit better, right? Because with interest rates going up, value can actually do slightly better. I mean, last 3-4 years, seen growth stocks do phenomenally well. The tilt of the portfolio is currently towards slightly domestic cyclicals, okay, because we're seeing that that will do well. So, like whether it is consumer discretionary, consumer durables, construction sector stocks like L&D, where we are well positioned. Even real estate sector, we have got some exposure. And I think the objective here will be to beat the benchmark consistently, which has done in the past so many years, last 16 years. I think we can still continue over a medium to long term. The second fund in the diversified category, I would say, is our flexi cap fund. It has got a slight value bias in this whole approach the fund manager has over here, which is also likely to do well. I think this fund has played out some of the sectors very well in the past, like the pharma sector, the telecom sector, which has helped. Currently, it is overweight in pharma, telecom, chemicals, also specialty chemicals. There's a decent exposure over here. Software, healthcare. These are sectors where it is currently overweight. And this fund, again, is very disciplined in terms of maintaining its mid-cap allocation or small-cap allocation, right? Which is typically between, say, around 20% to 35% in that band. And we think that in this, that is the best. I mean, that is the best combination of mid and small cap over a market cycle, okay, which does well. We don't want to be too aggressive over here on the mid and small cap or to this thing. And this fund has been again a steady performer, okay, in the past, generating decent alpha. And the fund manager takes slightly some contra bets, okay, which have played out well and given very good returns, okay, when they play out. And I think one can clearly look at this as one of the core part of their portfolio for the flexi cap or diversified category. Another fund on the same diversified category is our equity advantage fund. It is classified as a mid and large cap category. So the mid cap and small cap exposure here is between, say, 35 to around 50% in that range, compared to the flexi cap fund, right, which is 20 to 35% in that range. The characteristics of this fund is the positioning of the fund is that it is a slightly growth bias. So somebody looking at growth stocks, good quality growth stocks, I think this is the fund to look at. It has played some of these growth stocks very well in the past, and that has given it has bounced back also very well in the last 1.5 years. The fund played out the IT cycle very well. It was significantly overweight IT sector, both in the large cap as well as few mid cap stocks, and also some of the IT enablers, okay, which have contributed very well in the last 1 year, and one of the reasons why the fund has done well. So it tries to take some aggressive bets in some of a few sectors, right, which has been the characteristics of this fund, and that has led to the better returns. Arguably, it is slightly more aggressive also. You could see slightly higher volatility, but clearly a fund to look out for to really play some of these growth stocks or growth sectors in the Indian economy. Another fund, which is again a diversity, but this is a relatively new fund of ours. the whole ESG theme is slowly gaining traction. Globally, we have seen a lot of money moving towards the ESG theme, and that is also in India also slowly the whole environment and the E part of it is now getting more prominent. Earlier, it was more of governance, okay, which we saw, right? Companies with good corporate governance and they're saying getting re-rated over the last 3-4 years. But E also is playing a larger role globally. A lot of money moving into the clean energy and in that space. Still early days for this fund, but we think that ESG as a way of investing is also getting ingrained as a part of our investment philosophy. And somebody, if you want to play a diversified fund, but with an ESG kind of a overall blanket over that, then this is a fund to look out for. Still early days to say whether ESG as a theme will outperform the normal funds, but clearly the way the money is moving into the whole ESG theme, I think you will see this sector also coming of age. Finally, I think the mid-cap allocation, I would suggest a mid-cap fund, okay, which is kind of bounced back. It has had some challenges in the past. We had a fund manager change over there, but we have now come back over here. Slowly and steadily, the fund is improving. Earlier, there are a lot of cyclical sectors which were there in the fund. So now there's a good balance between cyclical as well as the the secular stocks, okay, which are there. And then finally, some of the thematic funds which are here, I think Vinod, if you could highlight these 3 funds are part of the key characteristics of these thematic funds which you are advocating.
Sure. So amongst thematics, the first is the ABSL Banking and Financial Services Fund. As you know, there is a wide variety of companies in this space. So you have the private and corporate banks, you have some of the NBFCs, you have the broking firms, insurance companies, life insurance and general insurance, housing finance companies, and so on. And even now, some of the new fintechs are also playing in this space. So this fund is a good fund to get exposure across all these sub-themes and subsectors. And we are quite positive on this space for the next 3 years. Like, as you know, credit is like the lifeblood of the economy. And if India's economy does well over the next 3 years, then all the banks and financial services companies should also show good performance and give a good return.
We can run it a bit fast. I think we want to spend more on Q&A. Just quickly, you can.
So Digital India Fund also, this fund invests in not only the Indian IT services companies, but also some of the other digital stocks, whether it's Apple, IndiaMart, and so on, and also gives exposure to some of the international technology leaders like Microsoft, Adobe, and so on. And it's also investing some of the new age IPOs that are happening. The third is the GenNext Fund, which invests in themes related to the youth in India. So, for example, low-ticket consumer discretionary, retail, autos, FMCG, banks, and fintechs, and some of the new IPOs like Nykaa, this fund has invested in. Lastly, to end on the balanced advantage and asset allocation. So as you know, balanced advantage fund invests mainly in domestic equity and fixed income and is driven by a price to earning based model. Current equity allocation is about 45%, and this fund has been doing quite well. And lastly, on the asset allocation front, we have the ABSL asset allocator, which gives exposure to 4 asset classes: domestic equity, international equity, fixed income, and gold. It's driven both by an underlying model as well as inputs from our fund managers and CIO. And current domestic equity allocation is 42%, international is 4%, so total equity allocation is about 46%. Gold is about 10%, and remaining 45% is to fixed income and cash. And this asset allocation fund has also done quite well. It's in the top 3 or 5 of the over short, medium, and long-term time horizons.
Thanks, Vinod. Thanks, Mahesh. Before just heading towards the first question, I mean, yes, I think everyone will get the link of this presentation on their respective email IDs, and of course, after 5 days, these links are available on our YouTube channels as well. So the first question to Bhavdeep, just will give a rest for a minute to Mr. Vinod and Mr. Mahesh. So there are a couple of existing schemes, like manufacturing fund, equity hybrid fund. So what should we do? I mean, should we stop, or the MNC fund? So should we stop the SIPs or should we continue with them?
Yeah, so I think every fund of ours has a particular relevance to investors' portfolio. Broadly, I would like to say, in the interest of time, that as Mahesh shared the presentation, that our house view has been that everyone's asset allocation has a space for about 15-20% for thematic and sectors investments, but the cumulative investment of all sector funds and thematic funds should not go beyond 20% of investors' portfolio. So that's one thing. Of course, manufacturing has its own appeal simply because this PLI is has kind of opened up that opportunity, or rather strengthened the prospects for manufacturing setup. My spoke about the private capex, government capex, etc. Kind of continuing from here, in fact, growing better from here. So in that context, yes, manufacturing has its relevance, and at the margin could actually improve the PLI and the extension of PLI, or the broad basing of PLI further from here could only improve the prospects of manufacturing. MNC is in quite a few of investors and partners actually relate with MNC as their retirement portfolio, because each investment that you look at in this portfolio is something you'd ideally like to own in your portfolio, as a company specific opportunity. So we believe that it's a long term investment, really long term investment, and something which is because the whole point there is our emphasis is more on the cash flow, free cash flows, low leverage or no leverage there, global brands, strengths in distribution, and the product capabilities, etc. So the MNCs actually get represented by all these characteristics of companies. And our belief is that even that is a very, very useful diversifier in the portfolio, particularly with long-term investments in mind. So I think as a bucket, what's important, and because this is Niveshko's Samvaad, so our all investors are there on the call. Our appeal again and again, we have been mentioning that asset allocation is key to long-term success of investments. So for long-term wealth creation, nothing works better than asset allocation, a balanced asset allocation portfolio with equities, fixed income, and gold and silver. Gold, real estate, and silver. And at the same time, within equities, also you want to make sure that large part of your portfolio is in large cap and multi-cap and flexi-cap portfolio, and only a part of your portfolio should go into about 20% in small and mid cap, and about 20, not more than 20% in thematic and sector. So just keep these asset allocation in mind, and if your investments are there in manufacturing and MNC, particularly SIPs, I think you must continue and not respond to short-term gyrations in performance.
Sure. Next question to you, Bhavdeep only. Very interesting question from Mr. Satish. Now there are index funds in the debt segment also. So how investors should see to it, or how should they evaluate it?
Yeah, so it's a very, very interesting.
Yeah,
so it's very, very interesting space which has opened up. For long we have been mentioning that, and we all know that mutual fund provides a very, very credible alternative to conventional savings options like fixed deposit. Not only because of the diversification and the liquidity part, but also because of the tax benefits. Now, this new opportunity, which is debt index fund, which has opened up, kind of not only provides you a good visibility of risk and return profile of the portfolio, but also daily liquidity. So essentially, for example, currently we are running a portfolio called SDL, PSU and SDL portfolio 2026. So what it means is that we are investing in a portfolio of public sector units as well, undertakings, as well as SDLs, which is essentially state development loans. So as this is a bond portfolio where we have these investments maturing in September 2026. So if you hold it till maturity, you have a fair degree of visibility in terms of where your investments are, because these are all government backed. There is a very strong creditworthiness of these companies, and you also know that currently at a portfolio level you get return of about 6.35%, or not return but the YTM of 6.35%. So if you hold it till maturity, pretty much like any fixed deposit, any fixed income instrument, you have the visibility of what return you could generate. And most importantly, it is also there is a daily liquidity available in these instruments. So that makes it a very, very compelling proposition for all FD investors. Just to kind of give you an example, this fund, if one remains invested till maturity, which is September 2026, could get a return of approximately 6%, post expense. And if you kind of take into account the indexation part of it, the post-tax return could be in the range of 5.75 to 5.8%. Now, for you to get similar kind of post-tax return from any fixed, any fixed income product outside of mutual funds, your pre-tax return has to be about 9.5–10%. So now, can you get an alternative of alternative fixed income product outside of mutual fund, which is very safe in terms of its credit worthiness, and still give you 9.5–10% kind of pre-tax return? And that really makes it a very compelling proposition. And we are currently also running one portfolio which will be maturing in 2027, and which will invest only in state development loans. So you know that there is no credit risk in this portfolio, and because there is a predefined maturity, the duration risk is very low, and then daily liquidity. So I think it's a very compelling proposition for any investor who is looking at investing for the next 4–5 years, 5–6 years rather, and get very attractive post-tax return at a very low credit risk. So my sense is it's a very exciting space going forward.
Okay, thanks, Bhavdeep. Next question to Mahesh or Vinod. Mr. Bhatresh is asking that, IT companies are seeing strong net addition of employees plus high attrition. So what's the impact on not just on the IT companies, but also on the consumption?
Yeah, so you're right. I think the IT sector this year, I think the IT companies will hire around 450,000 new employees, right, which is more than double what they have done in the last average over the last few years. So clearly there is a strong demand, and you've seen a lot of demand for new engineers or the new graduates, right? And the salaries are also kind of going up. So while, yeah, it is still a small segment if you look at compared to the total population, right? But clearly, I think these young people, okay, who are not only getting jobs but also getting decent, good salaries, will mean that I think in the pockets, especially in the metros, right, where there are large ITs, you'll see good demand for real estate coming up, because normally, not initially the fresh, but I mean, we've seen that after a few years, people want to really have their own independent house. And especially now with work from home, people are looking at independent house, and with interest rates being low, I think that should boost the real estate demand, especially cities like Bangalore, Pune, or other NCR, other regions, right? And also consumption. And consumption would be like more towards some of the discretionary consumption, okay, whether it's in the consumer durables or other items, okay, where one can see some impact of that going through. So yeah, it will mainly be the real estate and a few of these other consumer discretionary sector items where you could see some demand pickup because of the new job creation, okay, which is being done by the IT sector.
Mr. Kathir is asking outlook on metal sector, please.
Yeah, so the metal sectors did very well last year, phenomenal returns and very high profits, right? I mean, record profits, metal prices were at record high levels. There is some amount of moderation now, which is there in metal prices, especially steel and other areas. But I think metal stocks, I think one is that China growth is slowing down, right? So if growth slows down, metal stocks would normally, prices will get impacted. But what is happening is that the supply is also getting impacted, right? A lot of capacities are being shut down in China because of pollution norms and this thing. And in Europe, we are seeing another challenge, right? Energy prices have shot up, right? And a lot of these metal companies require energy as an input. And that is also increasing the cost of production over there. So in this current environment, that's why the metal prices, while they seen some correction and profits will probably decline next year, because this year has been record profits, but still there'll be decent profits. And a lot of companies are now actually seen a big deleveraging cycle, whether it is Tisco, whether it is JSW Steel, especially in the steel sector, has seen huge amount of deleveraging and debt has come down dramatically. So the balance sheets are in much better situation to take any shocks or any correction in the metal prices. So I would say that probably the returns might not be that great from here because we've already seen the big run up and profit growth might not be strong, but the companies are actually at reasonable valuations on EBITDA. So we are not so negative. We are actually neutral, okay, and especially more positive on the non-ferrous side, okay, than the ferrous.
Sure. Mr. Japesh is asking, sir, our wholesale price inflation is at 13.5%, while IIP is at 1.2%. These are the worst figures over the last 3 decades. Still, you are constructive on the market, whatever the views we are presented.
So you're right, IIP is low because of the economy is still recovering, right? We are still, there are certain pockets which have been impacted. So I see market is all about looking forward, right? Currently, I agree with you, the growth is still, but we expect that to recover, okay, as things normalize. Whereas inflation is concerned, yeah, there has been hyperinflation, which has been there globally. We've seen that because of the supply side constraint, commodity prices went up, metal prices are higher, energy prices are also on the higher side. And that it benefits a few companies like metals and certain sectors, okay, which have got pricing power, but it hurts a few companies, right, on the margin front. But our view again there is that inflation, what we are seeing currently, WPI, again, it's driven to some extent by energy or metals and commodity prices, I think will ease off. It has got delayed because of the second wave. There are some challenges again that the third wave has posed in terms of supply side disruptions, but these are transitory. And you will see demand or the supply side kind of matching up, and the inflation start to ease off somewhere in the second half of this calendar year, right? Even globally also, we are expecting that US inflation also, which is running at a kind of a 30-year high, should start to cool off. So I don't think structurally inflation, okay, should really stay at elevated levels. I think demand recovery also is not that strong, right? See, when inflation is high, when demand is very, very strong, it's not that strong. It's just about recovering. It's the supply side challenges which are there. So that's what I'm saying. While near term there are challenges, and that's why I'm slightly cautious on the market from a near term, because high inflation is the big risk, and recovery is also slightly slow because of the third wave. But see, market is all looking beyond this, right? Equity markets always look beyond the next 3 months, 6 months and look at. So our positive view is more on the outlook, okay, what we see, okay, say down the line. And near term, we also are cautious on the market, and we think that there could be possibly corrections which could be there. But that should be used as an opportunity to buy rather than being worried about these kind of numbers we're looking at.
Sure. The next one is how pure value fund is positioned to benefit from the views presented now. Mr. Sanjay is asking.
So specific fund, we can talk about this thing, but I don't think it is right. But again, pure value fund, again, it is now tilting the portfolio more towards, sectors like which are more domestic economy linked sectors, right? So that's where I think the fund is trying to be positioned at this point in time, and also a bit of mid caps and small cap are currently around, I think, 55% or so. I think our outlook on mid cap and small cap still remains constructive, but very stock specific, right? So to generate, in the past, the fund had got slightly higher mid cap exposure, but I think there is room to probably we would look to add more mid caps and small caps, okay, whenever we get an opportunity to get good stocks to generate the necessary delta, okay, in that fund. So it is there in some of the chemical space, okay, I mean, where we are positive on. On banking and financial, it is still slightly underweight, but trying to build position, okay, over there on the banking and financial side. And then on some of the other consumer, on the consumer discretionary side, also the fund has taken exposure. It's also increased exposure in the industrials and the capital goods sector. Again, that's in the sector which to play the whole manufacturing and the investment cycle. We've seen this fund increasing the exposure in the industrial and the capital goods sector.
Sure. Thank you. Next question to Vinod. What are the prospects of silver fund?
We have seen a number of fund houses launching their silver ETFs and silver fund of funds. Now, silver comes in the same like commodity asset class as gold, but there is a difference. So as we know, the key drivers for gold are typically the US rates, how the dollar is moving, and how the central banks, the demand for gold from various central banks and from consumers in India and China. And of course, how the inflation parameter is moving, right? So clearly inflation is high, is rising in the US, but it's expected to be transient and decline from March, April onwards. The rate hikes are expected, and the US dollar is expected to be strong, right? So given these factors, gold prices have been in a range between $1,750 to $1,850 an ounce. Given the expectation of inflation, there will be some support for gold. At best it may remain range bound or go maybe up 10% from current levels, but there may not be like a big rally in gold. Now, the reason silver is different from gold is silver is driven more by industrial demand, right? And we are seeing that global economies are recovering from the pandemic. Like we discussed, India is also recovering. So demand for industrial commodities and silver also is expected to pick up. So from an asset allocation point of view, we typically recommend between 5 to 15% allocation to the commodity asset class. And part of that can be to gold and part of that can be to silver. So silver ETFs or funds can definitely, give decent returns going forward.
Sure. The next quicker one is, how is the PSU as a theme going to perform?
PSUs again have been there's still value there in some of the PSU stocks. So value is slowly kind of coming back in favor. Okay, in the rising interest rate environment globally, we've seen value stocks starting to, especially utility space, oil and gas sector, and that's where most of the PSU stocks are. And in the PSU, while the divestment and privatization, I mean, the whole has got delayed because of the pandemic. But I think you will see that probably next year, no? Some of these things would take traction and that will unlock value in the PSU sector. There's still good amount of dividend yield in some of these stocks which are there. And so I think the risk reward in the PSU sector still looks good, right? For somebody looking at moderate risk, right? And also some kind of a margin of safety and looking at reasonable dividend yield. And as I said, this year is not a time to chase very high growth or very high returns, right? We're looking at more moderate returns. And the PSU basket overall has a potential to some amount of re-rating to happen, while earnings growth and this thing might not be as strong, but the cash flow and the dividend yield should provide some protection in the environment where we are probably like to see more volatility here. So overall, I would say the risk reward and the PSUs overall as a basket, right, which include utilities, oil and gas, even the PSU banks are also in a good cycle currently. Though we don't like PSU banks structurally, but they are in a good cycle currently, which they have done the cleanup of the balance sheets. Okay, credit growth will pick up a bit. That should help. And overall profitability growth in some of the larger PSU banks should be fairly good. So PSU bank still looks a decent risk reward even from here, no? For more conservative investors to look at.
Sure. What's your view on the disinvestment theme?
Disinvestment theme, again, it's still slow. Actually, the government targets are not going to be met this year. I mean, the whole LIC is one big issue which they're looking at in this year, but I don't know whether it will happen or not. But again, as I said, it got delayed because of the pandemic, right? A lot of investors, and these are large assets, they need to do the due diligence, which has not been feasible. So I don't think the government intention is lacking anywhere over there. We've seen, Air India happened very speedily it was done, right? Okay, because there was this dealing with one of the investors over there. So I think government is resolved to do that. And they've also announced a whole asset monetization program for the PSUs, right? In the last budget, I think you'll see getting traction next year. So, and the government is not trying to come to the market and raise money just through ETFs we used to do, right? So that means that's the only route for them to really monetize through this investments. So I think next year you should see that gaining traction.
Okay, we'll take second last question. Dollar is trending. So does it make any sense to invest in a US market or the international markets?
You see, dollar is trending, but I don't think dollar is going to strengthen too much. Okay, we've seen dollar rally play out to a large extent. Dollar will remain fairly firm or so. So I don't think in the initial period there is some reason for dollar to also slightly weaken later, because as you say, US overall as the whole fiscal stimulus and what has been given, right? Okay, there is likely to be some pressure, okay, because of that. So I don't see any major, dollar going, USD, will probably remain in a band or so, right? That's the first view on the US dollar. On US markets, I think it will be more driven by the US underlying growth, right? So last year was a very strong growth for the US economy, okay, which was record growth this year. Next year, I think looking at around 4.3, close to around 4% growth over there. Corporate profit growth will probably moderate down, right? Last year, it was calendar year, it was very strong, around 20% kind of a growth. This year, it will probably be around 10% growth. So US market will, and valuations there in the US markets are also very high, right? US is trending probably much compared to historical average. It's at a much higher delta even than Indian markets. So the return will be probably more moderate, but I think US market offers still more stability, I would say, right? There are a lot of good companies which are there, global companies which will continue to do well. So I think as an asset allocation to the portfolio, I think still looks okay to put money into the US markets, right? There are pockets of opportunity over there. It's expensive, but continue to remain expensive. But returns probably would be more moderate. I mean, that's probably the true across markets, I would say. So the view of investing into the market, yeah, continue with the allocation over there, not too aggressive.
Sure. Thanks, Mahesh. Bhavdeep, last question to you, and from very two different investors. So one investor who is asking, I'm a retired person, so FlexiCap is suitable for my, for my retirement kitty, and of course associated with that, 35% of the equity only I need to beat the inflation. So which is the product suitable for my retirement kitty? And the second question from the investor, who is one of the youngest, I believe, in this program, who is just 26 years, Mr. Shoner. So he is saying, of course, I've gone through your recommendation, but just I want to invest 5,000 rupees. So for the wealth creation for next 10 years, if any specific schemes, if you can suggest.
Yeah, interesting. So,
Yeah.
first is on the FlexiCap side. Yes, I think the way we run this fund and the fund proposition is, I think if you need to buy only one fund that serves all your long-term wealth creation needs, I think it should be a FlexiCap fund. And the reason is that in this fund we invest about 70 odd percent in typically about 70 odd percent in large companies, and about 30% in small and mid companies put together. And that is a broad representation of broad market as well. So if you were to look at all the listed companies in India and look at large companies, they contribute about 70% of the total market, and about 30% of the market is contributed by mid-sized companies and small companies. So that pretty much is the way a FlexiCap fund runs. And our FlexiCap fund, even the way it is being run, is more of with a philosophy of consistent compounding. It's not a fund which will really go for short-term wins. It's something which really focuses on the balance sheet strength of the company. And to my mind, yes, if there is one fund that you need to have only one fund for retirement fund with a long-term investment horizon of 10, 15, 20 years, FlexiCap could as well do the job. So yes, that is the first question, that from retirement point of view, just to kind of put it in perspective, this fund has completed about 23 years since inception, and it has delivered 23% CAGR return, compounded return. And what it means is that the 1 lakh rupee someone had invested at the time of launch of the fund, it has become 1 crore 20 lakh as we speak right now. So 1 lakh has become 1 crore 20 lakh over a 23-year period. Now that's what this fund has delivered over a long period of time. So I think, yes, it really makes sense for investor to sort of put retirement money there. On the second question, 5,000 rupees, 10-year money, of course, that's the kind of money that we really like to manage, because long-term horizon and diversified portfolio and India growth story, I think that's a very potent combination. And from that standpoint, I would suggest, of course, there is some lump sum money to invest. So you can invest, and since the corpus is 5,000 rupees right now, yeah, I think you can go for FlexiCap kind of fund, even for a 26 years old. But I'm very many congratulations that you are on the call on Saturday morning, Saturday afternoon, and attending session for long-term wealth creation. So many congratulations for getting it right. I think you have got the first step right, which is start investing early for long-term wealth creation. So so that fund makes a lot of sense.
Sure. And the last question to you, Bhavdeep, only, and which is a very common one, that current debt funds are comparatively low. our risk appetite is for the equity is just 20 to 40% only in equity exposure.
Yeah, so one solution is, there are two solutions we have for this investment need of investors. One is what we call balanced advantage fund, which typically invest depending on the market levels. Typically, all of us have the concern that market is too high or market is too low. We don't understand how will market behave in the next one year period or that kind of horizon. So for that, you be in our product for the next 10 years, but fund manager will kind of take decisions on your behalf, and in terms of how much to invest in equity at a given point in time. So balanced advantage fund exactly does that on your behalf, basis a particular framework, which is essentially buy low and sell high. So if the market valuations are attractive, they invest more in equity. And if market valuations are expensive, then they invest less in equity. Exactly the what is required for long-term wealth creation. So balanced advantage fund philosophy is exactly that. And currently we are running about 35 to 40% equity exposure in that fund. To kind of share with you, at the time of COVID, when entire market was selling, this fund had invested 80% of its money in equities. And as the market has run up a lot, of course, the long-term prospects are very good, but because it's a bit expensive, we are about in 35-40% range in terms of equity exposure. So this is one fund that is suitable for those investors, and another fund that asset allocator fund of fund. Now that is just one solution. If you want to have only one investment product, if you want to have only one equity product, flexi cap, if you want to have only one investment product across asset classes, debt, equity, and gold, etc., international equity, domestic equity, everything, then there is one solution, which is asset allocator fund of fund. And in that also we do invest in international equity, in Indian equity, in fixed income securities, also in gold. Not many products in the industry offer this kind of one-stop solution, and that's what our asset allocator fund of fund offers. So I think you can pick up one of the two funds and invest if you are a relatively conservative investor or a moderate risk investor, which is about 40% equity risk appetite. So I think these are the two solutions that come to my mind.
Sure. I think thanks Bhavdeep, thanks Vinod, and thanks Mahesh, for all the answers and for all the insights. Thanks all our investors, for joining over this call. Please take care. Definitely we will catch up with you every third Saturday of the month from 11 to 12, and looking forward to catch up with you in the next session. So be constructive once again on the asset allocation, on the equity and the schemes, definitely what we have gone through. So stay safe and take care. Looking forward to see you in the next session. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।